everybody. We're live. Russell Markham. I'm the Director of Education for VectorVest Australia. And what a pleasure it is today to be able to introduce you to Dr. Bill Dodd. Many of you know him well. He's presented at VectorVest in the past. So thank you, Bill, for coming along today. Bill's an independent investor, and you may have attended one or two of his courses in the past. And he does a bit of work there as well with the Australian Shareholders Association. So welcome, Bill. Thank you for coming along. I'm just testing, wanting to be absolutely certain it's all coming through so nobody misses this great talk that you're going to give today. So simple and profitable investing with ETFs. I'm going to hand over to Bill shortly, and then at the end, Bill will hand back over to me. And I'll run through a few techniques that I find very handy for investing into ETFs in Australia using VectorVest Australia. We'll also have a look at America, UK, and Canada, for example, at the ETFs there. Now, just before I begin, let's just move myself out the way there for a second. Disclaimer statement here. Please note this is our disclaimer statement in regards to our licenses. You can see our license numbers there. We're licensed through Central Wealth Pty Limited. You can also check out our financial services guide per our website there. All right, the second slide here. Any advice is general advice only and does not consider your personal objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. All right, so past performance is not a guarantee of future results. Forecasts and backtests used or discussed in this presentation today are intended as a guide only, and actual results may be affected by known or unknown risks and uncertainties and therefore may differ materially from the results ultimately achieved. Okay, with that said, without further ado, let me hand over to Bill. All right, so I've just got to bring up my control panel here and find Bill and move it across. So just bear with me. We've got a fair bit of technology on our hands here today, which is great. And here we go. So let's right click and make presenter. Here we go. Bill, I'll hand over to you. So thank you once again for presenting today. All right, so I think we should hand over there and I'll unmute you. All right, I'll mute myself. Thanks, Bill.
Thanks, Russell, and good morning. Well, let's look at the exciting opportunities that are available from ETFs. And I suppose we should start by saying, well, what is an ETF? An ETF is simply an exchange-traded fund, which is a managed investment fund comprising a pool of assets, and it's traded on the stock exchange. So it means that we can buy shares in an ETF exactly the same way that we buy shares in a stock through the ASX. Now, most investors are probably familiar with the passive index ETFs, for example, STW and IOZ. These are two ETFs which track the underlying ASX 200. So this shows one of the specific features of an ETF, that an ETF must track the underlying assets. Now, apart from the passive ETFs, there are many alternatives. And these are the active ETFs, which focus on a country, commodities, technology, or as we'll see later, specific themes. Some of the advantages of ETFs, as I see them, are first of all, the opportunity for diversification. Prior to the advent of ETFs, it was difficult to really buy into overseas equities at a low cost. And now we have that opportunity. They offer low fees, they offer transparencies, particularly when you compare them to managed funds and LICs. The fees are much lower, and you're really looking at an entity which you can understand, so they're quite transparent. They have lower volatility. Now, I should qualify that because some of the ETFs have volatility, but I'm looking for ETFs which have low volatility. Now, what are the risks when investing in ETFs? Well, there are quite a number of risks, and in some ways they differ from the risks that you encounter when you're investing in stocks. And what it suggests is that if you are interested in ETFs, that you look at this topic, the biggest ETF risks, on Specific risk. Now, specific risk for the stock is the risk of the stock failing. So if you have a stock which has poor fundamentals, you need to be very aware of the specific risk. Now, the specific risk with ETFs are much lower because, in fact, we're looking not at a single stock, we're looking at a managed fund which may contain 100 stocks. So specific risk is lower. However, we must still observe money management, and we should never risk more than 2% on any one, that's 2% of investment capital on any one investment. Liquidity risk is an issue, and I'll address that very shortly. Currency risk. If you're investing offshore, currency risk is something that you need to be aware of, and very few of these ETFs are in fact hedged. Country risk. Now, many of these ETFs have most of their stocks associated with a single country. For example, this particular ETF, it's the ETF ASIA. It specialized in Asian ETFs, but it was mainly looking at the ETFs in China. Now, when Chairman Xi started to look at his competitors around China, he looked very closely at these multi-billionaire operators of these big companies, and he very quickly put them into order. The consequence was that the value of these companies fell very dramatically, and you can see the result on this particular ETF. So what comes out of this is that you've got to be really vigilant with an ETF, and to my way of thinking, it's unwise to have a buy and hold attitude. You really need to look at these ETFs from time to time. Well, what do I want from ETFs? Well, I want diversification. These ETFs that I buy should not include Australian stocks, and they need to significantly outperform the ASX 200. Now, I'm reasonably confident that I can outperform the ASX 200 with the stocks that I invest in Australia. So that means the ETFs that I'm looking at from overseas must be at least as good as the ASX 200. I want low maintenance, and this means low volatility, so I'm going to select only low volatility ETFs. Well, where did I start? I started by looking at the ETF portfolios of two very experienced investors. I'll call them Jack and Jill. Now, this was Jack's, and both of these, incidentally, are buy and hold portfolios. Jack's ETFs gave an annualized return of 21%, compared to the ASX 200 over the same period of 6%, a pretty respectable return. And Jill's, while not quite as good, was still very respectable. So this, to me, said that there's a real opportunity in ETFs, and I'd better start looking at them. So I started by looking at all the ETFs, and I started by using VectorVest. So let's go to VectorVest. On the home page, I want to go to the viewers. And if we go to the ETF viewer, we see that VectorVest is covering 218 ETFs. So there are 218 ETFs available to us. Now, within this group of 218, there's a lot that are very poor performers, very similar to LICs and managed funds. So we've got to eliminate those. And also some of them are very illiquid. For example, this one here has a trading volume of only 471. We want to make sure that what we invest in is a liquid ETF, so that if we get in a situation where we get a market downturn and the buyers start to pull out from the market, there will always be some buyers for the ETF that we want to sell. So I started by looking at liquidity. And the normal way of approaching liquidity to say, well, look, I'll trade any ETF or stock if it's got 70,000 traded on a daily basis. But to me, this is not adequate because it doesn't differentiate between an ETF that may be valued at $700 per share and an ETF which may have a value of, for example, this one, $3. So the approach that I take is look for the dollars traded. Now, dollars traded is not an indicator that's in VectorVest, so you've got to create it yourself, which you can do in Tools, going to Custom Field Builder, And if I go to my dollars traded, this is what I'm looking at. And you can create this yourself, of course. So I'm looking at the price of the ETF multiplied by the average volume traded. I need to validate that, of course. If it validates okay, I've got myself a new indicator. So let's now click on dollars traded. And we've got those that are very liquid. Let me just check that. Okay, we've got the very liquid ETFs on top. Just make sure I've got that right. Now, what I want to do now is to save those ETFs that are liquid to a watch list. So I'll save these by clicking on my shift key and going down. Let's accept them from there. Oops, haven't got that. Okay, so I'll save those to my watch list. My watch list in my ETFs is here. This is the ETFs that are all liquid. I say okay, and they're now saved. Now, what I'm looking at now is the ETFs in my watch list, and it says there are 166 ETFs that have been found. What I'm now looking at is a list which by default is by declining value of VST. And VST, of course, is the master indicator, which combines RV, RS, and RT. Now, if we're looking at a stock, we can simply go to this list and we can pick the top VST, and it's likely to be a pretty darn good stock. So what I'll do, I'll take the top 10 of these and I'll put them in a comparison graph. Now, if you're ever looking at a new system and you want to compare what you're doing with, for example, the index, these performance graphs are really ideal. So what I'm doing here, I'm comparing the top 10 ETFs, VST. Now, hang on. What I should have done, I should have selected them on February the 7th. However, I'll go ahead and accept them as they are now. Take a little time to load because there's a lot of data to load. And what I've done here, I've pulled them out to January 2017. So we've got 5 years of data. Now, what I'm looking for is a portfolio of ETFs which outperform the index, and the ASX 200 is in red. So clearly what I've got here is a bunch of ETFs, many of which underperform the ASX 200. Now, this is a very disappointing result. I wonder where I went wrong, because if you're looking at this, I've got the ETFs, which are the top VST. But of course, what's happening here, VectorVest values an individual stock, but it can't put a value on a managed fund which comprises many stocks. So it simply gives it a 1. And the same with RS. So that means the VST that I was using, in fact, is mostly related to the short-term trend. And that's something that I'm not interested in. So VST, as it's set up there, is not useful, but all is not lost, because if I go to Unisearch and go to a search which I call Liquid Delta, it's a very simple one. It's addressing my ETFs that are all liquid. It's a delta search, and a delta search looks at a rate of change, and here we're looking at the rate of change of stock price over a specific period. So in this case, I've selected 1 year, and if I run this, this should now give me those stocks which are the best performers over a 1 year period. Now, what I'll do now is go to my presentation and look at how I'm going to handle those. So I've got these 180 odd ETFs. numbered from 1 to whatever. This is the top ETF over 52 weeks, etc. Now, I really looked and listed the top 40. So if it had, if it was in the lower group, I simply gave it a 45. So these are the top 18 in this situation. Now, what I really need, if I'm going to select a reliable group of ETFs, is to do this not simply over 52 weeks, but do it over another time period. And I've selected here 2 years, 104 weeks. Now, when I run it over 104 weeks, I find that in fact there's a very different situation, that these top 2 ETFs over 52 weeks were very poor performers over 104 weeks. And the better performers are these here. So what I'm doing now is taking an average of those. So this is the average performance of these ETFs over those time periods. And being in Excel, I can now click on this, and I can now sort these. So now I've got a listing of those ETFs, which in my view are the best ETFs available. What I've got to do now is select the best of the non-Australian ETFs. And in fact, there are no Australian ETFs in this top 18. So my filter really now is based on low volatility. And to illustrate this, let me look at 2 of these ETFs, NDQ and banks, international banks. This gives us a good idea what I mean by volatility. Now, what I'm looking at here is the ETF which tracks the NASDAQ, and the indicator I'm using here is the multiple moving average. Multiple moving average has 2 phases. It has long-term multiple moving averages in red and the short-term in green. And I think it makes life easier if we get rid of the prices. We're looking only at the moving averages. In my ideal stock, and I consider this, ETF, I consider this an ideal one. I've got the long-term moving averages that are moving upwards, and they're continuing to diverge. At the same time, they're well separated from the short-term multiple moving averages. So this, in my view, is the ideal sort of stock that I'm looking for. It's got low volatility. Compare this with international banks, and again, I'll remove the prices. This is quite a volatile ETF. Now, look, it might be suitable if you're a trader, because a trader can take a piece out of this trend here and a piece out of a trend here. But look, I'm looking at ETFs from an investor perspective, where I want very few trades per year. And I should say now that I wouldn't just have a buy and hold portfolio, I would manage it. So the banks is an example of the sort of ETF that I would eliminate from the list. So this now gives me my list of the best non-Australian ETFs. And what I should do now is go back to VectorVest and look at this list on a comparison basis and see how that compares with the index. So we go to graphs. I'm sorry, it's a little bit slow. It's annoying when this happens during presentation. Right, okay. Now what we're looking at here is the selection of ETFs that I got using VST. Now let's look at the selection using the Delta search. Let's have the same time period. And this is using the Delta search. A very different picture. We've now got the ASX 200, which over the period has performed at about, has returned 35% total over those 5 years. All of these ETFs are far superior to the underlying index and probably average around about 130% return over the period. So they're 100% better, if you like, than the underlying index. So this, as a group of ETFs, particularly using a comparison graph such as this, suggests that I'm on fairly sound ground looking at these 10 non-Australian ETFs. Let's go a bit further. Let's look at their distribution. Now, if you held all 10 equal amounts of each ETF, you'd have on average an 80% exposure to the US. Now, recall that I was looking for diversification, and this really was not my ideal. But the thing is, if I want to be truly diversified in ETFs, I'm going to have to accept a much lower performance. And since I'm after performance, I'm happy to go with this. So this is my portfolio of my 10 ideal ETFs. Let's have a bit of a look at how they're made up. Their allocation to their biggest holdings being Apple, Microsoft, Amazon, Google, etc., are as follows. So if I've got an equal holding in all of these, I've got a very solid holding to these 4 big companies. When we look at the fees, we find that the average fee is about 0.4%, which is a good bit better than you get with a managed fund. When we look at dividends, the dividends of ETFs are not good. Average of this portfolio would be 2.46, but remember that we've got one here at 6% and another one at 5%, which are putting an upward bias on that particular value. Their 1-year performance has averaged 34%, which is excellent, and their 3-year performance are not quite as good at 28%. Now, I've got one stock in here, one ETF in here, ACDC, which was a latecomer. It's only been founded some 2 years ago, but during its early phase, it was highly productive. It was one of the best performers. So what I've done, I've left this in my portfolio of 10. Now, of course, after 6 months, I'll review this portfolio, and if there are any poor performers, they will go out and I'll replace them. We must compare it, of course, with the ASX 200. So if you had invested in an ETF which tracks the ASX 200, you would have got a return of 3.4%, plus, of course, a small dividend. If you'd invested in this portfolio, you would have got a 10 times greater return. So I think this emphasizes how potentially useful the ETFs are in a portfolio if you select them carefully, because of course we've eliminated a lot of those ETFs which are poor performers. Okay, how should an ETF portfolio be managed? Most investors, in my experience, adopt a buy and hold approach with ETFs, and I want to compare the buy and hold approach with a managed portfolio. So this is the buy and hold portfolio, and I'm looking at only 5 ETFs here. Now, these backtests, and this is the managed backtest, these managed backtests, I can't carry them out in the backtesting module, simply because they involve the use of several indicators which aren't handled adequately by the backtest manager, but I can do them very nicely in the portfolio manager. And the advantage we've got with the portfolio manager, we've got access immediately to historical prices. So this is the performance of the buy and hold portfolio, very respectable, annualized 30%. But the ETF managed is much better. The drawdown is rather nasty. This is the peak to trough drawdown here, 31%. By comparison, it's only 12% with this ETF managed. Well, I considered 4 different management systems. The buy and hold approach, of course, and one using VectorVest stop and re-entry. Let me illustrate this just with this ETF here. The recommendations are on the top here. So if I'm holding this ETF and I get a sell recommendation, I sell this ETF. When there's a buy recommendation, I buy it. And the same would happen in this situation here. And of course, I'm in the position now where I've sold out of this ETF and I'm in cash. Now, the next two management systems are very similar. They both use an RSI entry and they both use an ATR stop, just a difference in the ATR stop. One is a 3 times and one is a 3.5 times. Let me start by explaining how the ATR stop works. And I should say that I'm working only with weekly charts. In my opinion, investors should work only with weekly charts because there's too much volatility to upset things if you're looking at daily charts. Now, this is the trailing ATR stop. And the point at which the price closes below the ATR stop is the point at which you sell. So in this situation, I would have been stopped out of, I'm using this example of NDQ again, stopped out at that particular point. I would have bought it in again, as I'll talk about shortly, and then having held it to this point, would have been stopped out at this point there. So that's using the ATR stop as a management tool. Now, what about entry? Well, entry is made using the RSI indicator. I'd like you to understand this RSI entry because I think it's particularly useful. There are many methods to enter a trade, but in my opinion, the RSI offers a lower risk and a much higher probability of success. So let's consider the advantages of an RSI entry, and I'll use it over a trending stock. And if you're using this RSI entry, of course, it must be a trending stock. Now, the normal way of approaching an entry is that you look at a previous high, and when the price takes out a previous high, this is the point at which you add this stock or ETF to your portfolio. This is a stop, and of course, before you buy it, you know exactly when you're going to sell it if things go wrong. So the risk per ETF share here is $2, 7 to 5. Now, I hear on CNBC that you should buy on the dip. Now, this is a lot of really, to me, dangerous rubbish because, yes, there's a dip here and you could buy on it, but when is the dip finished? In fact, it could go down further and further, and the stock could go into oblivion. The RSI, in fact, solves this, and I use an RSI with a 5-period look back. So it's used only with a trending stock, and when the RSI dips below the 50% level, that point there is the point at which I will buy this stock. So I'm going to buy at that point there. My stop is here. So that means my risk per share is only $1. A much better situation, much lower risk situation than the new high entry. And what it means, in fact, that for the same risk, I can buy twice the number of shares. Now, that's the system I'm using. So let's just consolidate this by looking at NDQ. So I have this particular ETF in my portfolio, and at this point here, I'm stopped out. Price is below the average true range stop, so I'm stopped out. I'm now using this signal for the RSI to enter the stock again. So I now hold it, and I'm stopped out again. So now I'm in cash and waiting for the next entry signal, which would be the next uprise here of the RSI. Now, what about market risk? Well, if you're looking at stocks, we manage our market risk by using confirmed calls, but we're looking at stocks which really are almost totally US. So if you're going to use this approach, you could use confirmed calls from the US market as an assessment of market risk. Now, I've done a little bit of back testing, just only admittedly on a few ETFs, to compare confirmed calls as a market risk management compared to simply using the RSI as an entry, and find that there's so little difference that it's much simpler to simply use the RSI entry and accept that because these ETFs hold so many stocks, that by using the RSI entry, the risk is very low, market risk is low. Well, let's look at the back test from these 4 different management systems. And I'm looking at the period from January 2017 to about February, only with these stocks, because this back tests were done, as I said earlier, in Portfolio Manager. And we start by looking at the annualized rate of return. Pretty good rate of return with both of these management systems, not bad with VectorVest. The drawdown, much too high with the buy and hold, and frankly, anything over 20% drawdown to me is a concern. But here we've got quite respectable drawdowns. The number of trades, of course, there's no trades with buy and hold, but these others had not a huge number of trades, considering this is 5 years. Now, we should compare this always with the underlying index. So over this period, and had you been invested in an ETF which tracks the ASX 200, you would not have made 5% whereas even with a buy and hold portfolio, using these carefully selected ETFs, you would have got 25%. Now, with any system, you can say that if it's a good system, you'd expect to get a return. So let me start that again. With any system, even if it's a good one, it's very difficult to get winners at more than 70%. But it's interesting that with these ETFs, we get a 100% winner with every ETF. There were no losers. And this is the best of these management systems. So let's look at all of the trades that were conducted over this 5-year period in this particular management system. And of course, with VectorVest, we can very easily follow up all the past history of trades. So no losers here. That one became mighty close, but otherwise a very solid portfolio. Let me go from here to look at the equity curve for the 3 times ATR system, which I've said is the best system. Looking again at only at these 5 ETFs, annualized return is 32%. The drawdown was 16%, and interestingly, it was during this last area of volatility. This portfolio, of course, now is totally in cash. Now, let me just briefly talk about the advantages, in fact, the necessity for a back test. With any system, you can only be confident about that system if you've done a back test. Now, having back tested this, I'm totally confident in using this system in investing in ETFs. However, if you don't back test, and you're using a system which may go sideways for a year, then you say, look, it's no good, I'll go to another system, and then you go to another system. The only way you can be totally confident about the system you're using is to back test it. It's really most important. Now, these are the returns in the past. Can we expect those in the future? Well, of course we can't, but it does give us an indication of the probability of returns of this particular portfolio. And even if it performs at 15%, half of what this one was, it's still a respectable return. Now, let me talk briefly about thematic ETFs. A thematic ETF is where the ETF focuses on a particular industry. For example, it might focus on robotics, cybersecurity, autonomous vehicles, any one of those. So it means that you can actually buy an ETF, and the total holdings of international shares in that ETF will be, for example, in robotics. Now, when you understand how technology is changing, this offers some wonderful opportunities. Let's have a look at the development of technology, starting back in the 18th century. The first boost to technology was water and steam power. The 19th century was a further boost to technology, this time when electricity was widely available. Then, of course, came the third industrial revolution, particularly through the middle of the last century, where we had the advent of computers and IT systems. That gave a huge boost to technology. But this is trivial compared to the boost we've got in the fourth revolution, which is including the things like robotics, autonomous vehicles, cloud computing. artificial intelligence, etc. So the opportunities that are only starting to emerge in this fourth industrial revolution are increasing productivity enormously. For example, during the first industrial revolution, there was an increase in productivity, much greater in the second industrial revolution. The third one was also much greater. But what we're seeing in terms of productivity in this fourth industrial revolution are extremely exciting. And this then leads us to looking at thematic investing, because this fourth generation technology offers us wonderful opportunities when we can focus our attention entirely, for example, on stocks which are looking only at cybersecurity or in any one of the others. Well, what I'd like to do is just to quickly assess the performance of these thematic ETFs by using this wonderful little tool we have in VectorVest called Backtest. And what Backtest does, it allows us to evaluate any portfolio in comparison with the underlying index over any period of time. And what I've done here, I've selected only a 1 month period in late 2021. I'm comparing it with the index, the All Ords here, which over that 1 month period did a very respectable 2%. Let's call it 2%. Compare that with the performance of these ETFs, which was vastly superior. So there are some wonderful opportunities available in ETFs, particularly when you look at thematic ETFs. But I should warn you here that many of these thematic ETFs have volatility. And as such, these would not be suitable for the sort of portfolio that I'm looking for. They have a place, and certainly they have a place for the trader. Now let me turn to buying and selling of ETFs. While we can buy ETFs on the exchange exactly the same way as we buy shares in a company, there really are some significant differences, and we need to understand these differences. When we look at the pricing of ETFs, unlike stocks, the ETF price is determined not by supply and demand. In fact, it's determined by the index or underlying assets. And in fact, the ETF must track the value of those underlying assets. And I gave you this example earlier where STW and IOZ were tracking very, very closely to the underlying ASX 200. Now, there's an issuing company, the authorized participant, is responsible for modifying the supply of shares to ensure that the ETF really does reflect the underlying assets or assets. In addition, we've got a market maker. The market maker could be a separate entity, or it may be the issuing company, to make sure there's sufficient liquidity in this particular ETF. So what this means is that the market depth of an ETF bears very little relationship to the market depth that we see for stocks, because in stocks it's based entirely on supply and demand. So let me compare the market depth screens for stock and for an ETF. I'll look at a company, I'll call it ABC, where we've got all the buyers and all the sellers. We can see that there are 50,000 units of interest to the buyers, and the sellers are interested in selling 51,000. Now, when we look up here, the screen now we're looking at now is the prices. But if in fact I had an offer in here and I wanted to know whether I was the top or the bottom of this lot, I could in fact go to orders and it would tell me where I was listed in these top four. Course of sales, of course, gives us the current sales. Now, these market depth screens to me are an invaluable asset when you're buying and selling. You know exactly where you are compared to other buyers and sellers, and you know what's going on in the market at that exact time. Now, the situation with ETFs are different. Take this as a typical ETF. We've got the buyers and sellers, but in fact, there is only 5 levels. When we look at prices, we have these prices now, but we can't look at the orders. Now, if I have an order in at this particular price, 9.54, and I want to know whether I'm next on the rank or at the bottom, I can't do it. I can do it in stocks, but I can't do it with ETFs. I can, of course, get the course of sales. So it means that we have a very different situation. The listing goes only normally to five levels. Sometimes it goes to 7, but normally 5. So it means that the rest of this is blank underneath. I suppose looking at an example would be better, and use the example of ETHI, which is the so-called ethical ETF. If you look at the market depth at 9:45, there's 15 minutes before market opened, we find that the buyers are looking for 2,300 units, and there's about the same number of units available for sale. So that's it before market opens. Now let's look at the market depth after this. Let's look at the market depth after market opens. I've looked at it at 15 minutes after the market open, but shortly after market open, this is what we'd be seeing. Where it started at looking at 2,000 units, we've now really nearly got 300,000 units for buyers, and the sellers are looking at 800,000 units. So what the difference is here, and we always see it in the top 3 levels, is the influence of the market makers, certainly, but of course the big influence here with the volume is coming from the issuing company. Now, it would seem to me that because the number of selling units is so high, that the managing company of this is saying, look, this ETF, in fact, has a value which is higher than the underlying securities. We need to put pressure on this, so we want to force the value of this ETF down. And that's what I would see was happening there. So what we're looking at is a very different market depth situation for ETFs, and it's much less help to us when we're buying or selling ETFs. The average daily volume for this particular ETF is 200,000 shares. So you can see here, this is very different from the implication that you saw at 15 minutes before open. Well, my conclusion, ETFs offer a low-cost opportunity to diversify a portfolio. But as with managed funds and LICs, there are many ETFs which are poor performers. So we've got to discriminate, we've got to sort out the good ones from the bad ones. And here, this is where VectorVest is such an excellent resource. I'm not sure how I would have found my best ETFs without having the ready access to really a pretty simple approach in VectorVest. And finally, thematic ETFs offer access to some of these extraordinary new technologies which are really just in their innovative stages. Well, Russell, over to you.
Thanks, Bill. Wow, what a great presentation there. So what I'm going to do here is I'm going to right click and make myself a presenter. So thanks so much for that, Bill. That was excellent. A lot of interesting analysis done there. At the end, folks, I'll read through the questions. So just to keep the flow going, and we'll bring up. There's a few questions in regards to that great presentation there. So thank you for that. Do keep them coming. All right. So what have I got for you? So I've got some additional stuff to share today. Just want to show you, this is no longer a disclaimer now, I guess, but this, just so you know, the number of ETFs, Australia 218, Canada 828, UK 457. I just quickly put this slide together while you were presenting it, Bill, because I just wanted to give attendees just an idea. US, this is how many ETFs we track. So if you take out a subscription, VectorVest, a lot of you are subscribers in attendance today. We also have a lot of new people, so if you're wondering how many we track, these are the numbers of ETFs. So a lot of ETFs. US there, 1757, so nearly 2,000 ETFs being tracked there. Okay, so what I'm going to do now is I'm going to jump into VectorVest, and let's start with Australia. All right, so within Australia, so if you're new to VectorVest, you haven't seen VectorVest before, it's a great system. You know, you do need to be a little bit patient when you first learn it. I think a lot of people they want to know everything straight away. And I often say to people that are new to VectorVest, take your time, learn the things that you would like to learn first. and then master those. I'm just double checking my sound here, and then master those things that you're after first and foremost. So if you're after ETFs, this is one such way that you can do it. So you hop into the viewers, and we've got the ETF viewer. So you can see there are 218 in total. And from here, I can then scroll over and I can see the different types of ETFs, how they're made up. So I can see at the moment here's a currency ETF, then I've got an international, an Australia broad strategy, commodity, etc., etc. So I can double check the classifications. And what I can do with a few clicks of a mouse every day is I can say to VectorVest, well, show me what is the fastest moving ETF currently. All right, so I click on this indicator here, relative timing. It's looking at short-term price momentum. I can say, oh, okay, it's the triple O ETF, crude oil. No surprises there. Oil prices going through the roof. We're all feeling it there at the petrol pumps. And let's just clean it up just a tad here. There we are. There are the technicals firing up. Look at that oil ETF. So it's gone from, what was it, about $6 odd back in January this year. And it's currently trading at around about just shy of $9.50. So a big pop up there in the price. Another one here, global energy. You know, it's not just oil being impacted, it's all the commodities there associated in the energy sector, gas, coal, you name it. They're all going through the roof with what's going on in Ukraine, with the war there with Russia, and that's driving up those commodity prices, which in turn drive up those ETFs associated with those commodity prices. So just, you know, a few clicks of the button, there it is. Okay, so that's one such way. The other such way is in Industry Viewer. You can view some of the best performing industries. All right, so again, VectorVest will sort these by relative timing on a scale of 0 to 2. So the quickest moving industries have the highest RT scores on a scale of 0 to 2. So I can see, all right, aluminium's right up at the top of the list. And if I scroll down to the bottom here, I can see consumer staples and household personal items down at the bottom of the list. I guess makes sense. We're all tightening up our spending habits as things are becoming quite expensive. All right, with inflation. But you can see as I scroll down here, I can see, oh, okay, currency ETFs. They're right up there in terms of some of the best performing industry stocks. In this case, it's ETFs. I can see ETF sector. I can see ETF AU broad and strategy and commodity. So ETFs are featuring very highly among some of the best performing industries. I recall when I first started presenting VectorVest, it was certainly here in Australia, it was fairly rare to see, you know, ETFs at the top of the list 10 years ago. We didn't have that many. But as time has progressed, as things have moved on, and more ETF stock getting listed, this is starting to become more of the norm rather than the exception. So don't be surprised if you see ETFs up at the top of the RT lists more often than not. Okay. So now let's say I say, okay, well, you know, currency, it's interesting. I don't really know much about currency ETFs, but, you know, VectorVest, tell us a bit more. So I'll just right click here and I can view stocks so here, view stocks in industry group. There we are. So VectorVest will then load that up and I can then bring this over. All right, so here we are. So in here, ETFs currencies, right? So here are all the different currency listings. ETFs that are shaped in one way, shape or form via currency. Okay, so that's a very handy technique. The other place I like to look at as well is within our powerful tool here called UniSearch. So what UniSearch will do for me is it will go and screen all of the stocks and ETFs for certain parameters. Now, there's a reason why I've put this back to the 25th of May for this analysis here. Back in 25 May, the market was moving up quickly. So, you know, when I'm looking to buy in an ETF, you know, I would like to buy it in a surging upward market. All right. The market's getting pretty close to finding its market bottom. Time will tell. I don't know whether this is a fake breakout before it goes back down again. We're noting to our subscribers we're in a confirmed down, our most conservative of all of our down signals. So the up signal's not been signaled just yet on our confirmed calls. So we'll wait. But when we get the confirmed up, who knows? Maybe another breakout to the upside? Time will tell. All right. So If I go back in anticipation for the next confirmed up, let's say it was there or there, this one was very short-lived. All right, but if I go back to this one here, which was a quite sizable rally, this market's been quite heavily sold down, so I am anticipating a bit of a rally in potentially the next cycle. I can't advise on it. I can't tell you. Nobody can tell you definitively what's going to happen, but we can certainly use history and go back in time and look at what's happened on average using the tools of VectorVest. It tells me that we've got a good chance of bouncing up at some point. All right, so just going back historically on an ETF for this example here for a bit of fun, let's actually I'll go back to my uni search. All right, so there we are, 25 May. There are the parameters. So can't be less than $1, don't want a penny ETF, at least 100,000 trades a day. Sure, I know there's liquidity that is made for the ETFs, I get it, but nonetheless, just the average volume traded, just to make sure there's plenty of liquidity. It's not a sell rating, so we rank our ETFs buy, hold, or sell. We want to be careful of the sell rated ones. So if I move it across here, let's see, here are our rankings, okay? So I don't want a sell rating, must either be a buy or a hold. I don't want any short ETFs, so we track ETFs that what we call contra ETFs. They do the contrary to what the market's doing. So if the market's going down, they go up. If the market's going up, they go down. They're certainly designed to do that. There's several of them now in Australia. It doesn't always work out like that, but you'll find that there's a pretty strong correlation between a down market and an up ETF, and the ETF coming up in price, the contras, and vice versa. All right, so if I move myself out to the way here, let's just use this tool. So we've got the quick test tool in VectorVest. It's just a quick rough snapshot. It just gives you an idea. There's no risk or money management rules. There's nothing. It's just a quick point A to point B test. So if I said, look, if I pick those up 25 May back all the way until 23 March, the market went up 0.19%, and these ones went up, double digits. They're at 13 odd percent. Okay, so we've got all these different strategies. So in our uni search tool here, we've got this group, as we call it, a folder, and it's got all the different types of ETFs that you can go and look for. Okay. That's Australia, and I'll jump into America now. But before I do so, I wanted to also show you we track a portfolio. So if I go to VectorVest portfolios, we're not fund managers, we're not brokers. We track this for education purposes, and you're most welcome to check out our ETF portfolio each and every day in the VectorVest system. Here are the several ETFs. We've got 5 at the moment that we're tracking. Here they are. And here's been the performance since 2013. So it's doing about 12 or 13% annualized, excluding any dividends and or franking credits. So you can see how it's been performing. 2022, it's come off slightly as the market's come off, but the overall trend has been very impressive. There's the COVID market sell down, and it bounced off that sell down quite well indeed. So there they are. You might want to jot some of those codes down and see what you think of them. I can't advise. I can't tell you whether they are suitable for you or not, but this is what we're tracking each and every day in VectorVest, along with several other pretty explosive portfolios there. All right. So with that said, let's jump into the US. Now, the US has got, many ETFs in the US. You can see currently, if I go back in time as of the 14th of October, and I'll show you why I'm doing that now, there were 1,696 ETFs being tracked in the US. Now it's just over 1,700. So you might be saying, well, hang on, why are you going back to 14 October? Go back to our graphs. There is our entry that we provided to our subscribers on the 14th, and there was a pretty explosive rally despite a pretty heavy market sell down that followed shortly after towards the end of November. But nonetheless, 14 October there, that was pretty impressive, a little rally pop in the market. So let's test it all the way from here all the way to there. Despite this pullback, let's see if our ETFs hold up. All right, so let's do this, ETF viewer. And what I've done here is I've sorted these ETFs by relative timing times CI. So relative timing, if I just graph the first one here, It's looking for the short-term price momentum. It's a technical indicator. So if I put it on, it's looking for this. It's looking for the technicals shooting up. Here it breaks above 1, very strong rally, right? So it breaks there at 80, above 1 and around about 87. And look at that, hits a high point of, what was a high point of 187. So this was a very impressive ETF. And then if I add in this parameter here called CI, the comfort index, and what it's looking for on a scale of 0 to 2, if you're seeing your CI holding above 1 steadily like that, it's telling you that this trend is fairly sustainable. Nothing in life is guaranteed. I can't say just because it's well above 1 and holding above 1 it'll be like that forever, but it certainly gives you a lot of peace of mind. So it's above 1, holding steady, technicals above 1 and rising. That gives me peace of mind. All right, so putting that together, if I just simply go and sort all the ETFs in America that we track by relative timing times CI, going back to the 14th of October when we gave our subscribers that entry signal to consider going back into the market. All right, so let's do it. Let's quick test, let's say the top 10. So here we go. Look at that. Despite riding during, despite all the time since November onwards, where the market has fallen away heavily, I thought this really was impressive. 48% returns despite the market falling 8%. So, relative timing times CI in America is proving to be an incredibly resilient and powerful set of parameters, at least in current market conditions. So, I would have expected some of these to fall a bit more or not have been as well returning because of what's going on in the market. But there you go. VectorVest helped pinpoint that. So, you can experiment. If I was to roll that 4 down till your current date, close business as of yesterday, all right, 23rd of March, and then rerun it. There we are. So here are the ones that are popping up now. All right, so if I graph the top one here, UCO ticker code, all right, it's picking on that trend starting to break out to the upside. So look at those powerful tools at your fingertips. It makes life a lot easier. Okay, the other thing I want to show you, that's one way of doing it. So using the powerful ETF viewer. Another way of doing it is Unisearch. And I want to draw your attention to this. So if you take out a subscription, you get to log into 5 different countries. You just log in accordingly as part of your subscription or trial. You can trial at VectorVest for $9.95 USD, call it 14 Australian dollars for 30 days. And I would encourage you, if you take out a trial, do this. Log into America, go to Unisearch, and then open up this group called ETF Challenge. So we've had challenges over the years where we've put it to our many thousands of subscribers to say, show us an ETF strategy that works really well. And we've offered prizes and incentives, and it works out really well because it's a win-win situation. Our subscribers get value out of this, and of course, those that win the competitions win prizes. But look, the end game is to empower you, and that to me is what I really love about VectorVest. We empower each other. So I just picked on the first one. I have no idea what this was about. AW, I think that was the initials of the entrant, person who entered, and I'm not sure what L means. It just depends what the competition coding was at the time. But nonetheless, I just want to show you this. If I run this entrant over here, this person's entry, so they were using a trending strategy, making sure that the technicals were trending up, at least 100,000 trades, and that these were all ETFs, and then they used price divided by stop to give us a combination there of what they were looking for. And for whatever reason, this one here, if I quick test all right, and I'll just go back to the start of the year. So this was just the very first one I found, and I thought, okay, well, let's see what you're currently finding, and how's it kind of performed over the last couple of weeks. Look at that, wow, 88%, some amazing ETFs in that list. So I'm just saying, maybe have a look at some of the entrants in there. Some of our members spend hours formulating a strategy, so you can go in and double check what they're up to here. All right, so there was one way. The other way, ETF challenge. So again, still with a new search, open up this group here called ETFs, and I found this one which produced some pretty spectacular results as well. So this one here, 50-day moving average, greater than or equal to 100,000. This is the volume, 100,000 trades. Sector equals ETFs, and then sorting in RT by descending order. So it's finding those quickest moving ETFs. No surprises, oil up there again. And if I do this quick test all and just go back to see how they've been performing since the start of the year. All right, and again, just go back to January here. All right, 3rd of Jan, and run that test. You know, another spectacular set of results on those ETFs. So it's a good starting point to give you some ideas. The other thing I want to share with you in the US, and you're going to have to sort of brace yourself for this because it's probably some of the most spectacular results I've ever seen, but a word of caution, it's highly risky. So if you were going to risk any capital, like Bill said, no more than between 1 to 2% of your investable capital. So what I'm saying by that is if you had $100,000 to invest, you would not risk more than $1,000 or $2,000 into this type of strategy. And again, I'm not advocating you do it. This is not advice. This is just simply something I wanted to draw your attention to, and you might investigate it further. So in our online investment club, we've got our next meeting coming up this Saturday, so I can't wait to run that again. We've got some great talks coming up. But what I wanted to show you was this in Backtester here. So this is a strategy on a triple leveraged ETF. So the underlying asset managers of the ETF leveraged at threefold, so not for the faint-hearted. And the TQQQ tracks the NASDAQ 100. We all know the story behind the NASDAQ 100. It's got some of the best technology companies in the world behind them, held within the NASDAQ 100, so your Facebooks and your Googles and the likes. And this has been the performance of this backtester strategy using TQQQ. It's had a heavy sell down since this pretty much the start of this year. So a few of our club members and the likes are looking at this very closely to say, you know, could there be a buy-in opportunity shortly? I can't tell you, but who knows? Time will tell. You can see it's been sold down quite heavily, but nonetheless, we got to work. I remember in one of the presentations there, I presented and I tried to find a couple of strategies backtesting the TQQQ based on our online groups there in the US. Okay, so let's see, can I minimize this down here? Anyway, you can see I got some pretty spectacular results there of 7,388% return. So we turned, what was it? What did we turn it into? We initially started, it was a very small amount. I think it was like 5 or 10,000. Yeah, so the $5,000 US, so a small sum of money. Now that might not be 1 or 2% of your investable capital, but we took that as an example, 5%. Sorry, 1 or 2%, 5,000, and we turned it into on the back test to 374,000 USD. All right, so just an example of a pretty risky and exciting type of strategy for an ETF. So if you get the chance, have a look at the VectorVest system on TQQQ, have a bit of a play, look at some of the presentations behind it. There's certainly been some quite spectacular results. The drawdowns are intense, you know, so this is the most that a portfolio lost from a peak to trough cycle, 69%. I think 99% investors would freak out at that. 41's a bit more manageable. It's still pretty heavy in terms of a drawdown, but nonetheless, so if you get a chance, have a play in the VectorVest system with TQQQ as a strategy and see the type of results you can come up with. All right, moving around the world. So I did want to show you just one or two others. Here's Canada. So again, you know, I put this on 19 October. The reason for 19 October, just like with the US, you know, if I come back here to market timing. So here's market timing, and there was our last entry there, 19 October, despite the market. It rallied a bit, and then it's pulled back, but 19 October, and I come back into the ETF view at 19 October, sorting it by RT times CI again, and let's grab a top 10. So here's Canada, and a very respectable 34% odd. The market went up 11%. All right, so that was pretty impressive. So that was Canada. And let's see, what else we've got? UK, so you can also track the ETFs in the UK. So same deal, went to the graph. 22 October was, actually they've just had a new signal that's just popped up on 21 March, so we can start looking at that strategy shortly. But the last one prior to that, actually I think I went back a little bit just to get a bit of a rally. That one there was a bit of a pop. This was very short-lived. 22 October. So here we are, 22 October, and RT times CI, and look at that, 48% during that time period. The market went down 4.8%. So you're starting to see a quite interesting pattern globally here. Let's have a look just out of interest on here. 22 March, let's just double check. There was no, 21 March. So 21 March was the confirmed signal. If I go here to my date, let's change it. Let's bring it through until 21 March. Here we go. And RT times CI, here they are. Let's grab the top 10. So it's only been a couple of days. And there we are. There's a quick 4% again. So that strategy seems to be working quite well in the UK, America, and Canada at the moment. All right, so there they all are. So just a quick sort of a whiz with some of our key countries from around the world. Keep an eye on the VectorVest ETF portfolio as well for a bit of fun. And don't forget your uni searches. We're back in Australia. Here's one that works pretty well at the moment too. All right, so look, I hope you've enjoyed the power of what we can do here at VectorVest to our subscribers. Of course, you've probably seen a lot of that already. I hope there was a good refresher for you as well. All right, so with that said, Bill, I'll put your microphone on as well. My microphone's on, and I'll read out some of the questions. I know we're running a wee bit over time, but I think I don't think anyone's complaining. It's been such an interesting session here. So let's see here. So a few members had mentioned there, Bill, I think with your graphs today you were using Guppy multiple moving averages. If we could just confirm that.
That's correct, yes.
Yeah, so Guppy uses several multiple moving averages. In VectorVest, you can build your very own as well. All right, so if you wanted to go and add in fact, if I go back to, say, currency ETFs, just to show those that are new here as well, you don't necessarily have to use Guppy per se. I think he does a brilliant job. We teach courses on how to set it all up. Have I got Guppy loaded here? Here we are. So here's a whole lot of Guppy multiple moving averages here. But what you'd simply do on your price, I'll just turn this off for here, just to make it a little bit easier. What you can do here is you can put on several different multiple moving averages. So I'll just clean it up a bit, just there. So if you've got your price, right click, add moving average, and you can add in different moving averages and then track them. All right, so thanks for the questions there on multiple moving averages. Toy notes, dividends are tricky to work out as ETFs buy their trust, whereas LICs and shares are and companies, I think, are easier. Rules have to be they have to distribute capital and earnings. So many say that a few divs gave a 10% payment typically at the end of the year, but some do it quarterly. I think what you're saying there, yeah. So companies will pay those out quarterly, interim and final, whereas ETFs may not always be as clear cut. And I'll check that with Bill. Bill, I think with ETFs, your strategies, you're mainly looking for capital growth as opposed to ETFs. So if I could just confirm that.
Oh, sure, Russell. You know, the return from the dividend return from ETFs is really pretty mediocre. So what you're looking at is a capital gain, a steady capital gain by selecting these non-volatile ETFs.
Yeah, no, good point.
And incidentally, just to follow on there, you were talking about the Guppy multiple moving averages. In my view, it is one of the best ways of understanding the trend. And I think an investor buying any stock or buying any ETF, if they can look at the trend and say, well, the trend is stable, and then say, well, look, also the fundamentals are good, then they're buying something that's got a high probability of success. So the trend using Guppy's model moving averages is really something that I think is worthwhile looking at.
I agree. I know when we were running the mastery session for Stan Heller's multiple moving averages course, and he made use of Guppy's technique, and this was probably one of the most favored layouts on multiple moving average layouts. So there it is. You can really see that trend, can't you? So the blue turquoise line here are the quicker moving averages, and the red is the slower. So I think it's as clear as day what the trend is doing here. Here you start to see it break down, so you've got to be careful. Here we're starting to see a great trend developing back to the upside again. So yeah, no, thanks for that, Bill. It's a very good point. Let's see, Patricia notes, ETFs are open vehicles. This means that if you want to buy or sell them, the market makers will buy or sell more of the underlying shares. Therefore, the liquidity is not an issue for ETFs, whereas, yes, it's an issue for the LIC. So why do you think it's important to look at ETFs liquidity? If I could put that one to you, Bill, or happy to answer it too.
It's an interesting question. My first step is always to look at something as liquidity. Look, I can't easily answer that one. It's just the liquidity is my first step. So it's the first way that I can eliminate those ETFs that are less desirable. But the point is well taken, that you've got a market maker there, so that there will always be a market in it, even in a downturn.
Yeah, it's exactly right. I mean, look, the way I view it too is, if there's a lot of liquidity taking place, well, then I don't rely on the market maker. Whereas if I have an ETF that's got low liquidity, and all of a sudden, I'm a fund manager and I've got $200 million to invest into an ETF, let's say, for whatever reason, then I have to approach that market maker to say, well, can you make the liquidity for me? What happens on the flip side if you want to sell all that out? You'd have to go back to the market maker. The market maker is going to have a pretty tough time getting you in and out. So why not operate within an ETF that's got oodles of liquidity already that fits to your requirements straight away?
Russell, I think that's right, and really the crux of the answer there is that if you are in an illiquid ETF, you're at the mercy of the market maker. So you're dependent upon what market is there. According to that market maker, it may not be the sort of market depth that you want.
Yeah, exactly. The market maker's going to have to go to meet the market effectively, rather than the market sort of meeting you. Okay, no, thank you. It's interesting. I think for most of us, we're not going to have too much liquidity issues if you're just looking to invest a couple of thousand here or there. But if you're looking to invest a larger sum, definitely, why not get something that's liquid already? Let's see, Patricia notes, it's only when the underlying holdings are liquid that risk to have a wide spread, which of course is not that great. Yeah, and that's a great point. That's kind of what we were saying as well. So thank you. All right, let's see. I'll move on. Thanks, Toya, as well as Patricia noted a bit more on liquidity, but I think we've covered that well. Let's see. Mark notes, thanks, Bill. Great, worthwhile presentation. Helen notes, will a copy of the presentation be provided to share with my husband or replay again? Now, here's good news. If you go to YouTube, so if you go to youtube.com and type in VectorVest Australia, we're broadcasting live there right now. Okay, so it's going to be on the YouTube channel. Let me see if I can find it. Where are we? Here we are. Okay, so if you go to youtube.com, you type in VectorVest Australia. Here we are. I won't click on this because it'll double up, but it's going live right now, so you can watch the recording immediately. All right, let's just while I'm on that as well. So if you're new to VectorVest, you want to take out a trial, VectorVest.com.au, and you can click on risk-free trial to get access. Let's see, next one here. Is ATI, average true range, measured from a weekly high or weekly close? asks Bob. So if you just confirm on your presentation there, Bill.
You can use either, of course, but it's generally accepted that the closing price is a better indication of the true value. So always work ATR on the close.
Okay, excellent. Great, thanks for that. Let's see next one here. Also asked by Mark. Bill is using weekly charts. Are entries and exits made during the week or at the week's end only? So, are you doing it during the week or closing out only at the weekend?
Look, it's an interesting question, and if you look at charts, the sort of charts that I've shown today, you often find that at intra-week you will have a spike where the price goes below the average true range. So really, you're probably better off having a system say, right, I'll use an ATR stop at 3 times the ATR, but I'll only sell on Fridays just before market close if at that time the price is below the stop. It's one way of reducing volatility, put it that way.
Okay, thanks for clarifying, Bill. Yeah, I mean, weekly does certainly give you an easier trading system, but day to day can certainly save on that volatility. Let's see, Sean notes, what is the amount to enter in dollars traded custom fields? I think that was that custom field that you were referring to, Bill. Sean just wants to know what dollar traded amount do you think would be worthwhile using?
Oh, yeah, right. You're just entering the current price of the ETF multiplied by the average number of ETFs traded, shares in that ETF traded over the last, I don't know what the default is in VectorVest, but I think it's something like 15 days. So it's price multiplied by average volume traded.
Right, yeah, actually that's a good point. Yeah, so just on that, Sean, I've just jogging my memory, I've set this up in the past at Q&As, whatever have you. I'm just trying to remember here. So I called it turnover, same thing, dollars traded turnover. So it's just simply, if you wanted to set up your custom field, just give it a name. So turnover or dollars traded, whatever name you prefer. And you can just literally just type that in exactly as is, price times, just asterisk, volume. That's it. So that would be the price of the ETF in this example multiplied by the shares traded or ETFs traded on the current day. So that's how you can do it. Okay, let's see here. An excellent presentation. Thank you very much. Notes. Helen notes your sound has gone off. Russell, hopefully it's all working. Let's see, Toya notes, liquidity and spreads are limited by legal requirements of market makers, but also in part determined by what an ETF holds. If small caps, then less liquid with wider spreads than large cap ETFs. All right, so thanks for noting that there. Patricia also notes, Russell, what do you mean by penny ETFs? I thought the concept was only applicable to stocks. Yeah, look, I've probably sabotaged that name. Typically, we hear the term penny stocks. In other words, stocks that trade under $1. I've just coined it penny ETFs. Is there such a term? There's probably not, but basically I'm just saying ETFs trading below $1. Let's see, next question here. Sorry, I'm turning my head, but I'm looking at the other screen with the questions coming in. Patricia notes, it's maybe the price of the ETFs made by the average of the prices of the underlying stocks. That would explain why you talk about penny ETFs. Yeah, no, exactly right. I'm just talking about, it's just simply the current price. Let's see, can Bill apply his selection techniques to the US market? Notes Robert. So I'll hand that question to you there, Bill.
Yeah, absolutely. I can use exactly the same technique.
Okay, yep, great.
And of course, the approach I've used, I today talked about 1 year and 2 years, and averaging the performance over those periods. You may seek to use different periods than that, or even more periods, but the same approach could be applied to any market or any ETF market.
Thanks, Bill. Thanks for confirming. And here's the thing too, with teaching VectorVest for over a decade now, and Bill's a long-term user of VectorVest as well. He'd advocate this. Do not assume that, what you do in one country will necessarily work perfectly in the other country. Each country has its own unique twists and turns and idiosyncrasies, for a better term. Nothing beats, like what Bill said, nothing beats a back test. So apply the concepts that Bill's noted today and then refine them. So, okay, RT times CI, it works in America, it works in Canada, it's working in UK, great. Let me back test it. Is it necessarily going to work in Australia? You might find it's a slightly different derivation. Just because it's working now doesn't mean it's going to work in 6 months' time. All right, so that's the beauty of this tool here. Your back tester, get in and test your strategies and use what's working now. I think that's what Bill was saying. It's a brilliant tool. Make use of it. Let's see. The other thing I wanted to note here, where was it? Unisearch. So when I was looking at entrant, ETF challenge entrants, LS. So thanks, well pointed out by Alan and Mervyn. Long, L for long, S for short. Okay, and hence the triangle pointing down. These are shorting strategies. These are long, for going long in the market. Yes, you can do shorting strategies for ETFs in the US because you can make use of the contra ETFs, for example. Okay, let's see. ETFs specify if they pay quarterly, semi-annually, or annually, or annually, notes Helen. Sorry if I'm not reading this correctly. So ETFs specify whether they pay quarterly, semi-annually, or annually for the ETFs. Okay, in their PDS statements. So thanks for noting that, Helen. Let's see. Helen also notes any presentation on understanding guppy graphs in VectorVest. Yes, there is. There's a course in the VectorVest University called Mastering Multiple Moving Averages. So if I come back to Australia, it's in the VectorVest University. There is a charge for that course. Stan Heller did a brilliant job on it. So if you did want to do that course, it is a paid course, but it's well worth every cent you'll spend on that one. So the VectorVest University, and within there, there is a Mastering Moving Averages course. I ran a mastery session on that late last year, and we had incredible feedback for that course. Okay, so I'd need to come in here and find it, but it'll be here. Mastering, where is it? Mastering Moving Averages. There's a lot of ones here. It's just a matter of just finding it. So you come in here and find it, and you can read up more about it. There we are. There we go. All right, so there it all is. So you can see some of the things in there, and Daryl Guppy features in one of the modules there. All right, so I'll just minimize that out and back to viewers. All right. Next question in. John notes, when an ETF gives a sell, do you use a daily close below the stop or at the end of the week? So I think we've answered that one before with Bill, but I'll just confirm that with Bill.
Yeah, I work entirely on weekly charts, so the management is on a weekly charts. But of course, sometimes if you have a volatile market, you will get a close intra-week, even on a weekly chart. So you probably don't get very much difference in performance overall of an ETF by using one versus the other. And I think the safest one, particularly as an investor, is simply to use the late on Friday afternoon. You look at your ETF and it's below, you sell it then. There's less administration of a portfolio that way, and I see little advantage in looking at intra-week.
Okay, thanks, Bill. No, thanks for confirming. Just on here too, I just want to confirm if it's okay with you, Bill. Our subscribers are asking, and a few new attendees as well, saying, would it be possible if we could share your slides with attendees today?
Absolutely. I'll forward them to you, Russell.
Excellent. Okay, thanks, Bill. That's very kind of you. Where are my questions gone? Sorry about that. My questions are hiding. Let's just make sure I bring it back up. Detach them. Here we are. I don't know what I've done to the questions here. Okay, the other question there is, there was one of you asking here in regards to what's the difference between annualized rate of return and a compounded rate of return, CROR. So one is referring to a compound. What that means is that if you've got $100,000, how much is that $100,000 growing a year? So if it compounds every year, it grows. So let's say year one, it grows to 110,000. Right, then the next year, how much does that compound by? So you're taking the 110,000. If it grows 10%, then it'll be 10% of 110,000. All right, and then so each year it's compounding upon the growth. Annualized rate of return, basically how it calculates is it says, okay, you started with $100,000 and you ended up with $1 million over 10 years. So on average, what did the $100,000 grow at by each year? Not the compounded amount, the initial $100,000. Okay, so that's the difference. Look, the best way to view that is if you hop onto Investopedia or one of those websites, they do a brilliant breakout of how it's calculated. The other place to go and have a look at is the Online Investment Club. I think it was last month. Let's just double check when it was last month, the 26th of February. One of our presenters there did a brilliant job and showed mathematically that how you calculate a compounded versus an annualized rate of return. So at the end,
Russell, can I just comment on that one?
Yes.
Can I just comment on that? The industry standard is to report the results on an annualized basis. But that really is misleading because the annualized rate is very different to the compound annual growth rate, and the compound annual growth rate is much closer to what the investor actually gets in his or her pocket. And the difference, it's all a matter of volatility, of course, and the compound annual growth rate, which we really should quote in all publications, is the one that really is a reflection of what we're going to make in any particular system. And you can see the slide that Russell just put up now, how different they are.
Yeah,
so
it's a good point. It's a good point because you see when you look at this, you say, oh, okay, it's annualized 91% returns. Yeah, wow, that's spectacular, right? So since this test was run from 2015 to 22, it's annualized on average made 90% returns here on the initial sum invested, right? So when you look at that, you go, okay, well, that looks spectacular, but Bill's right. Look at the volatility. All right, so if you got in here as an investor, you certainly haven't made 90% returns. You've lost money, right? This is a highly risky, put all your eggs into one industry type thing, the iron ore industry. When it ran well, but I remember the time when we showcased this, we noted it was a very risky strategy. But having said that, look at the compound rate of return. So it's a wee bit slow here. So the compound saying of the initial sum invested, the returns have been about 30-odd% here, so a big difference. All right, so view annualized with compound in addition to drawdown, because if you've got a big drawdown, it's saying that this portfolio has been fairly volatile. I like to find ones where they are quite similar. So what I mean with a low drawdown. So for example, here, I'm seeing here a max drawdown of 9%, so it's not too volatile. Very, very smooth portfolio for this one, for example. Your compound versus your annualized is quite similar. That's because the time periods is only for a year. But let's see if I get one that's run a little bit further. For example, here I'm not seeing as big a discrepancy. 13% compound, 27% annualized, 21% drawdown. So that to me on a back test there it's a much smoother portfolio. Right? So we give you all those tools and you can play around with them. But yeah, I agree, Bill. I think one needs to look at all the different parameters provided. Let's see here. Peter notes turnover suggests price times the average volume, not the volume. Yeah, so look, turnover in its true accounting sense is price times the volume, but if you do average volume, I'd then call it average turnover. So it's a good point. It gives you a much clearer picture because you might be seeing a massive spike on a day for whatever reason. It's not indicative of the average. Peter also goes on to note for TQQQ strategy, look at Bob Turnbull's bull strategy, VectorVest Canada. So for our VectorVest subscribers, those who take out a trial, call support, ask them for Bob Turnbull, no relation to Malcolm Turnbull. Look at Bob Turnbull's bull strategy for Canada using TQQQ. Yes, I recall at the time. Very, very impressive. Let's see here. John notes, can you provide a link to Dr. Bill Dodd's work? Yes, we'll get that out. Let's see, Chris. Not now, because Bill will send it through and we'll package it up and send it on the replay. Let's see, Chris asks, hi Russell, where are the Guppy moving averages on VectorVest? Thanks. Notes, Chris. It's not something that we have in there. We probably need to get permission from Daryl Guppy to have it as an actual set on our graphs. But if you Google it up, you can certainly find out a lot on it. What we've done here is we've just taken multiple, it's a bit slow my system, multiple moving averages and applied it. So Guppy uses several different multiple moving averages. I think it's exponential moving averages. So if I put in a graph or an ETF, so let's put in, everyone knows this one here, Apple, here we are. I've got it on my different graph layouts here. Let's see here, graph layout. Okay, so you can experiment with them as well. I think in Daryl Guppy's presentations as well, he does talk about being able to use different variations, but there it is. All right, so exponential moving averages. So you need to right click on
Russell,
price. Yes.
Can I just comment there, Russell? Anyone that wants to know more about the multiple moving averages, it's worth reading some of Guppy's books, and there are many, but he's really summarized all of that work in an excellent book. It's about 10 years old now. It's called Guppy Trading. And that will tell you all you need to know. It'll tell you the values of the exponential moving averages and everything you need to know.
Thanks, Bill. Yeah, excellent. I recall meeting him at the ASA. He often presents at the Australian Shareholders Association, doesn't he?
Yes.
You can't mistake him. He's got a moustache, a great moustache, and I remember talking to him. He's got a great sense of humour as well. So if you do bump into him at the ASA, speak to him. He's well worth your time. There we are. So there are some of the. So what you do on your price, you right click and you add, and then in this case you need to put on the exponential, right? So they're all the different ones here. Let's see. Yeah. So there's another question on ARR and IRR, I think, or CROR from Patricia. I've recently come across IRR as the only return for some funds. Can you explain the difference? That takes me back to my days of being a financial analyst. So when you ran project economics, you'd calculate the annualized, we often reported it as ARR. Now, if I recall correctly from our finance days, IRR, internal rate of return, I think that's the return required to break even on the project, if I recall. I can't quite remember. It's a corporate finance term. It's a return required. So I think it's a return required to either break even or to get to a certain return that you're after. Leave with me the next Q&A. I'll go and dust off my corporate finance books and just double confirm what an IRR is exactly. I do recall building spreadsheets with IRRs back in the day, and I just need to double check how those calculations are done. Excel does it automatically for you, but I want to go back and brush up. So leave that with me there, Patricia. Our next Q&A session, which is, where is the next Q&A? The 6th of April. Send me an email just in case so I don't forget, but I'll cover IRR at that Q&A session that we run for our subscribers. All right. It looks to me like all the questions have now come to an end. So, Bill, thank you so much. I know we went a little bit over time, but I guess I'm not complaining. Wow, what an amazing amount of knowledge today. Thank you for sharing all that. All right. So thanks, Bill. So at this point here, did you want to say anything else, Bill? And then at that point, I'll close down.
No, I think not, Russell. Thank you very much indeed.
Thank you. All right, folks. I hope you got a lot out of it. Thanks, Bill. We'd love to have you present again in the near future. Thank you so much.
Thank you.
Thanks again. Bye, folks.